What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What's up, everybody? I'm back with another edition of the Macro Insights podcast, and I'd like to thank everybody listening on any podcasting 2.0 apps such as Fountain and Streaming Me Sats. I really do appreciate it. And remember, to help the show grow, I would really appreciate it if you like the video, if you're watching on YouTube, and subscribe to my YouTube channel or subscribe wherever you get podcasts so I could keep bringing quality guests and bring some great insights in a bunch of different industries to you. But I have a very special guest. He's been on the Twitter Spaces a few times, and he's going to start coming back a lot more. He's kind of migrating over from the from the Clubhouse realm over to Twitter Spaces. But I've got Shane, my resident real estate expert. I don't know where he went. He just walked away real quick. I'm not sure if he went to go grab something or whatnot, but there he is.
Sorry, brother. I had a pin fall and kind of roll out of thing, and I was like, oh, he's going to say my name any second, and I'm chasing a pin over here.
No worries. But we got Shane, man. How you doing?
Good, brother. How are you doing?
I'm doing well. For those who haven't heard you on the Spaces or heard you, in Clubhouse or anything else, why don't you tell us a little bit about yourself and how you got here today?
So guys, I'm a single family investment consultant, 1 to 4, 5 to 50. Also, I'll evaluate LP positions. Have been building a virtual community and doing a lot of masterminding through Clubhouse. Some are real estate professionals and experienced and seasoned investors, and others are just people that are wanting to get in the space. The reason I say that for context, it's allowed me to have people that have gotten to know me through social audio spaces connect with me meaningfully and share insightfully what's going on in their markets. So I'm kind of guiding them to understand better their investment strategy, but also how to leverage where their financial position with their market. And through that, it just keeps expanding my ability to understand what's going on nationwide. That's kind of a quick intro. So I'm a real estate gun for hire. When you are an accredited investor, or if you're an established kind of tier 2 investor where you've been doing this for several years and you've got good cash flow. I specialize more in lifestyle investments, legacy investments, and people that are going to do out of state capital placement, or if they just kind of want a mystery shopper to make sure that LP position that they're considering for syndication is going to go well. And as a result of that, it takes me around the country. It also has relationships around the country, and we've actually got a couple clients internationally that are doing stuff here in the States. And so it gives me a unique perspective, but also knowing guys like Brandon and having been introduced to him by people like Bobby J and Neely, just a fascinating group of people that I've been able to connect with throughout Corona through social audio spaces like Clubhouse and Twitter Spaces, and get to know how other experts in their different lanes are seeing the crossover areas of real estate and the economy and bonds and debts and corporate and everything of that nature.
Yeah, exactly. And I think, the reason I want to have you on here today is to get more of like an overview on how real estate has been going as far as this first quarter in this year, because I feel like since Corona, there's been kind of the initial decline and whatnot, but it seemed like everybody kind of rushed to, maybe get their single family home. The interest rates were extremely low, but now we have the Federal Reserve raising interest rates and other things like that. So, why don't you, I guess, kind of explain the housing cycle that we've kind of gone through the past 2-ish years. What you're kind of seeing through Q1 of this year.
Well, first thing I told Brandon is we're going to do several of these because there's just no way I could lay out all of the proper framework over one conversation. But if we're going to kind of dial into some key factors for this first conversation to a new audience, those of you that have been following me in other social media spaces, forgive that you're going to hear some things that seem a little bit redundant, but hopefully we'll throw some new twists into the conversation today to make it interesting for you. The first backdrop I want to point out is every MSA has an equity runway. That is how it's performing. That's how it's growing. And when you look at, well, let me dial back. So when I first got onto Clubhouse, after figuring out what it was, like all of us were, I started finding myself in spaces with other real estate agents, professionals, investors, syndicators, big equity, private equity, mid-cap placement size funds, just all kinds of different things. And we were having fascinating conversations, and two things were new to us. Number one, the technology of social audio. Number two was this very collaborative curiosity to see what was going on, because Corona was impacting everything economically, and obviously that was going to come down and settle a lot with real estate. So we were all having these very collaborative conversations to figure some stuff out. So someone who's kind of focused on several states and probably a dozen MSAs over the last several years started to really be able to understand what was going on nationally. And one of the biggest things I learned early on when I started my journey, kind of did a pivot about 10 years ago, was there's a huge difference between the Midwest and the West. And it's not just culture, but even real estate is a huge difference. If you look at the Four Corners and the way they've grown, especially Utah, Arizona, and Colorado, they have had a total different trajectory, which has made that equity runway very unique. So as far as appreciation, market rent, all of those things going up dramatically. You've seen Colorado, Utah, even Idaho now, Montana's really come onto the scene. You've seen a lot of the mountain states have strong appreciation, increasing, rental situations and all that. Now, what was going on in the Midwest and in the Northeast is as a result of what happened in the global financial crisis, a lot of neighborhoods were beat up pretty badly, and it was taking them a long time to come back on track. Within less than 6 to 12 months, when we kind of officially got out of the global financial crisis, Colorado was just off and running. And it's one of the reasons that it was kind of ranked in the top 10 categories for most real estate stuff for the last 10 years. It's been pretty dominant in a lot of categories, because a lot of what had affected and impacted the Northeast and Midwest just didn't affect Colorado as much coming out of it. The global financial crisis affected everybody. I lost a lot of real estate. My business kind of shut down during that time. I had a mortgage broker that was kind of creating a real estate investing firm filled around it. And not a lot of people survived a couple of years there. But once we came out of that, it started creating an equity runway. And different parts of the country were coming up to speed in different ways. And so when you got into Corona, that was a big factor. So like you take markets like Portland, Seattle, and Denver, they were really ready for some correction. And the reason that it didn't come to them was because interest rates that were dropped to help us come out of Corona really spurred on growth that was not healthy in a lot of ways. We were ready to correct our values, or at least pause and slow down. And all of a sudden, you're buying a $500,000, $600,000 house, and you couldn't have bought a $400,000 house. And so that gave people that were coveting the next neighborhood over or the neighborhood up the ability to go in and get that for the same price, because interest rates had spurred that on. As a result of that, it created a frenzy across the country. Some of those markets, like Denver, are already seeing pullbacks and little micro bubbles in different neighborhoods that are kind of popping because there wasn't really a very good, backdrop for those neighborhoods to keep going up in price. I mean, we have done really well as an economy, but we can't necessarily sustain the prices and rents that were coming to our market. So there's a kind of a come to Jesus moment for those of you that can recognize that language for a lot of the country. Some people were just hitting their stride during Corona, and they'll continue to grow, and they haven't seen they've seen a slowdown because of rates, but there's really high demand, and other people are really coming to a reckoning of either a pause, a correction, or maybe even in some cases what seems to be a little bit of a mini crash. So I think however you want to dial into the last 2.5 years we can, but that's something important to kind of recognize is the different places that different cities and metro areas were in before we even got to Corona. And now, as a result of kind of a market shift, how they're reacting to interest rates and, of course, the most recently bank conundrum. So go ahead, brother.
Yeah, for sure. So, I mean, all that is interesting and a great kind of like overview as to where we've gotten and where we're, potentially going. But, just like kind of anecdotally, I'm starting to notice it here in Tampa where I'm at. So, I live on this street and they had two homes for sale starting in November, I believe, of last year. One was completely finished and redone, and that one sold almost immediately. And the other one had needed some work, and it's still on the market. They've dropped the price, I believe, by like $85,000, and it's still up for sale. So I imagine like that's kind of the scenario. Now that we're getting, along these lines where houses are kind of more on the market for longer, dropping in price, and because those monthly payments are going up. Do you think that that's kind of a trend that's going to continue based on what we're kind of seeing around? Or do you think that, because we're having maybe less buyers, maybe less people kind of coming in for, maybe their first actual like home, or maybe their first investment property, where we're having a lot of those, senior debt investors who have a lot of cash maybe on the side or something like that, that they're going to start swooping in and getting these homes for a little bit lower than expected?
All of the above. There was a very interesting article that I'll focus on a little bit in some of the stages that I have coming up in Clubhouse and Twitter with you, called "What America's Biggest Cities Look Like 100 Years Ago." It was by John Harrington. Fascinating. If anybody out there knows John, reach out to him. Tell him that I've done a lot of indirect research off of his article, and that I put boots on the ground in 70 MSAs in 2 years, and I'd really just love to have a conversation with the guy. But one of the things that was pointing out was a working thesis that I've had on a national narrative for a long time, which is America is really quite officially divided into 5 to 7 different paces and kind of trajectories. For lack of better description, a lot of times on Clubhouse or sometimes on Twitter Spaces, someone will hear me say, "Hey, be aware of whether you're in a no growth, slow growth, or strong growth market." That's just a quick way to give context to what applies in Los Angeles doesn't apply in Denver, it doesn't apply in Nashville, Tennessee, it doesn't apply in Cedar Rapids, Iowa, Grand Island, Nebraska. I actually haven't been to LA in quite a while, but I've been to both San Diego and San Francisco in the last little while. And, when I go there, I focus on transitional urban edges, and I also focus on the city line to see what growth really looks like. The reason I say that in context to some of your question is, that article did a great job of showing cities that were in their heyday 40, 50, 60 years ago, and now are back to sizes that are where they were 100 years ago. It's pretty crazy. So when you look at a Chicago, a Detroit, a Philadelphia, you don't see a lot of growth. Those are no growth or negative growth markets. And if you look at a Denver or an Atlanta or Seattle, just phenomenal growth. So there's no way to put a strong growth market into the same place as a no growth market. You just mentioned Tampa. So the Carolinas and Tampa have been probably some of the hottest markets this last year. Tennessee, I think, is cooling down a little bit compared to where they were, but still really good situations. And so when you look at, a lot of what's going on in what we'll call North and Central Florida along the coastlines, when you look at what's going on in the Carolinas, Texas experienced phenomenal growth, but it's slowed down compared to where it was. What is it that drives or pushes those factors in place? I want to quickly bring in another article that was an opinion piece by the Wall Street Journal. We did a very interesting stage. I have a club called Dream Team that was co-founded by myself and JM. And we just don't mess around with who we let up there to have a conversation with. They have to be an expert, luxury, real estate, big real estate, an operator. They have to know their stuff. And we did a stage on that Blue Exodus article. And Lee Brown, who's the vice president for the National Association of Realtors, was pointing out a lot of interesting policies that NAR was having to deal with the DOJ, and a lot of lawsuits that were going on. So there's the the legislation that's going on with realtors right now that's going to change the industry. But then there's a lot of, what that article pointed out was a lot of local legislation that has really kind of inhibited meaningful economic growth for places like New York, California, Philadelphia. So when you have places like Florida, Arizona, Texas, Colorado's been relatively moderate so far. We have some problems on the horizon, I hope, that go in our direction for landlord friendliness, that have been landlord friendly and investor friendly. That favors them dramatically. The other thing, weather. You can't help the fact that, as much as I love Rocky and Philadelphia, it's a cold place. I'm getting ready to go there, at the end of this month, and I'm glad I wasn't going there in February. So it's one of those situations where, just weather, winters, more, it's ironically, there's about 20 to 25% people, depending on the consumer surveys that you look at out there, that do want a winter where they live, but that still leaves 80 to 85% that don't. So, obviously weather is favoring that, along with friendly landlord situations. And the one thing that we need to add to this narrative is what I will call equity rich capital. So, if I bought a house in a nice neighborhood in Denver, 10 years ago for $200,000, it's possible that house is worth $1 million. Maybe I put $80,000 to $150,000 of upgrades. Maybe I put sub-zero Wolf appliances in there. But the house on its own merit went up almost, 4 to 4.5 times without any upgrade. And so if I'm selling that $1 million house last year during Corona or the year before, and I'm going down to Tampa where you're at, I can buy that same caliber house for probably half the price now. If I did that like 2 to 3 years ago, I could have bought it for like a third the price. So imagine what that looks like when equity rich capital decides that it wants to relocate. We already had the baby boomers that were retiring, but during Corona, we had a lot of people that were able to all of a sudden, after 6 to 12 months of not being called back to the office, they were just able to move wherever they wanted to and work from home. So, when you look at that pipeline, those are 3 of the 4 or 5 big things that impacted who was coming and why, the supply was not keeping up with the demand.
All right. Yeah. So that's great on, the supply and the demand of the overall housing. But I kind of want to get into like the rental markets and a little bit like dive into there, because I think that's kind of a curious point too. That's almost like, I guess sideways affiliated to the overall prices of homes and other things like that. So, as far as like long-term rent goes, in places like Tampa, it seems like it's skyrocketed, right? I mean, I moved here 4 years ago. So anecdotally, I was renting an apartment that was, I believe, like 1,600 or something like that when I first started renting it. And then when I left a year later, it was like 17. And now it's that same apartment. It's a single bedroom, home. It's in a nice location, but it's now renting for like 24 to 2,500. So we're seeing like a lot of, rental boom in a lot of these areas, but I'm hearing in, areas like maybe like Philly or New York or Boston, where people are kind of moving away, we're not seeing that kind of rental, I guess, boom. Maybe rent is going down, but I am seeing, some friends that their lease is coming up, and although the rents have skyrocketed, they are kind of leveling out here. So is that something that you guys are kind of noticing as well, that with these home prices kind of going down and stabilizing, that is also kind of bringing down the rental market?
You hope so. And in some parts of the country, that's happening quickly. Part of the fall depends on how real the rise was, right? Was that just a hot air balloon that was creating, this massive inflation of appraised value and rent? Or were there real economics behind why those rents were going up, why those prices were going up? It's funny that you said Tampa, and I know you're down there. But for a little bit of context, most of the names that I'll be mentioning are top 1% in their industry by production, extremely well respected in their backyards. If people don't like them, it's usually because they're jealous. But Amanda Dahl is down there in that Tampa area. And someone I became good buddies with on Clubhouse. We share a lot of virtual stages. And I remember her coming to a Dream Team stage that Joseph and Glenda and Jam, I think, were there. And we were having conversations about some of this. And one of the things that was super interesting was she was just talking anecdotally, her own personal rent, and how it had just skyrocketed. And having had meaningful conversations on the app, knowing Michigan, West Michigan a little bit like I do, knowing Denver pretty well like I do, having had confirmation in the mid-luxury and luxury space from a good friend, Chris Davis, who really dominates there, Glenda Baker in Atlanta, we're in strong growth markets. And West Michigan is an okay growth market. It's not Grand Rapids is a very unique city that's really coming on in the Midwest, but it's not quite, it doesn't have the math to be a strong growth, maybe an okay or good growth, but it definitely is counter most of the Midwestern cities and their trends. The reason I say that is when I was hearing stories about Tampa and Carolina, it was just blowing me away. And my concern there was, just because you're getting the rent today doesn't mean two things. Number one, it doesn't mean that the way you underwrote the renter, because a lot of times in property management, they'll just do 3.5 times rent. So someone has $1,000 worth of rent and they make $3,000, $3,500 a month, then they're like, okay, you can come in. Well, that's not a very sophisticated way of underwriting a renter. Good people will actually take into consideration the car payment, the debt, the student loan obligations. Our dear friend Neely has talked about how those student loan obligations were not being performed on for a long, long time, and they were going to re-enter the market. So what does that do to someone's affordability or their other availability to afford the rent that they've been put into? So the second piece of the puzzle is, outside of perhaps poor underwriting, there's a lot of newly formed syndication that went out and bought multi-units that didn't know what that it was doing. And they definitely didn't plan for the interest rates. They didn't plan for this kind of a market. They kept thinking things were going to go up. That doesn't also tell you about the performance. So you can get, 100 people in at to rent something for $1,000 or $2,000 a month. But what if you're having to evict, 10-20% of them in the next 6 to 12 months? What if you have to evict another 5 to 10% of them in the 6 to 12 months following that? A lot of syndications built on cap rates and margins. They don't have the ability to navigate that kind of disoccupancy and that kind of non-performance in their book. It puts them in a very compressed situation, and there's a lot of syndication that's failing right now because it wasn't well underwritten, and it bought aggressively, or it bought ignorantly, I guess would be the best way to say. Some of the syndicators that we collaborate with, and a lot of conversations on Clubhouse, which hasn't happened a lot in the last several months, had exits. So you're the new guy coming in, and you're paying the premium for the old or kind of newer but not too new guy coming out. And so they had exits to those people. And in offline conversations, or sometimes publicly, they've often said that they had doubts about how the people went about to kind of come in and buy that property. Now, when they sold to a bigger institutional group, they're much more professional. And the reason I say that is you don't want there to be a collateral damage of a ton of renters out there that their living situation drops dramatically because there just wasn't very good underwriting to acquire the property in the first place. So I think because of syndication, and I also think because of just Main Street landlords who have pushed the envelope for what rents can be like, they're coming back down. You see a lot of the older and probably mid-season landlords, 5 to 10 years, a little bit of equity, a little more cash flow. They haven't been pushing that as much. They've been just leaving good tenants in place. But you had a lot of new landlords that needed to push those to pencil or to kind of justify the leap of faith that they were taking to risk into the market. And I think they're going to struggle.
So when you talk about underwriting and doing a syndication in multifamily, I think maybe the average person that listens, it's give or take if they really understand the differences between, maybe a 30-year fixed here in the United States and what it takes to, go through a syndication. So, why don't you, I guess, break down those differences and, why maybe the underwriting for a multifamily deal in a syndication is so important?
Yeah. So I guess what I'll say here is, for me and my clients and a lot of what I'm doing, I'm now kind of focused on the top 100 real estate markets by cash flow and the top 100 real estate markets by performance. And within those, I personally favor either a C+ neighborhood that will go to a vendored rent tenant, so something like Section 8 or Veteran Housing Affair. In West Michigan, you might have a Bethany Housing or West Michigan Catholic Charities. Or I'll go more to a B or a B+ neighborhood. A lot of times on the investment side, we like to grade things A through F. And I always want a A-, B+ grading if it's a bigger city, because I don't want just A in somewhere like Atlanta. I want to know if it's like A-, B+. The reason I say that is that's a place where I feel like there's going to be safety. Section 8 renters are always looking for good places. If you can be a good tenant, I mean, if you can attract a good tenant that has fully vendored rent by the government, that's going to be fine. It's the stuff below that and the stuff in between that and the B plus that's going to struggle. The B plus stuff in popular neighborhoods in popular cities is always high demand. People want to be in those neighborhoods. They're usually transforming. Neighborhoods like here in Colorado might be like Highlands, which has been really popular last 10, 20 years. I'm actually sitting in Rhino. There's a little thing here in the back with this Airbnb of one of my clients. You can kind of, let's see here. There's a little rhino in the moon back there. And that stands for, the River North Point district here in Denver, dramatically transforming. People want to be in these kinds of neighborhoods. They want to be in Ottawa Hills, or they want to be in Heritage Hills and Grand Rapids, maybe the Northwest side. So those neighborhoods are doing well. It's everything in between the C plus and the B minus that you have to worry about. And it's everything below C plus, as far as rental concerns, as far as neighborhoods taking a step backwards, losing value, as far as rents, kind of imploding. Because what most people don't realize is how much the typical landlord and property manager in a probably C plus or B minus neighborhood or lower, they're at the front line of really helping that neighborhood curate stability. If you have tenants running amok in a neighborhood, then crime is going to fester. And if crime can develop, then the neighborhood starts going backwards, right? And if crime goes backwards, schools go backwards, all the magic indicators that you need for a neighborhood to go well start to work against you. So I look at that from the standpoint of what we're focusing on to invest in. And then I'm worried about the things that can't give us either upside or safety or both, as far as what we're trying to put our capital into. When you talk about the syndication, it's just a lot of people that didn't execute right. They didn't do things right. They didn't pencil the properties. It's really not been too expensive for most people to have me evaluate LPs, because if I know a good syndicator, I'll tell them. If I don't know the syndicator, but I know the what should be the going rent rate and what should be the going situation for that area, I'm able to turn those around in like 20 minutes to 2 hours and just say, don't do it, or yeah, it's going to be a good fit for you, because it really starts out with good rent and the tenant. If they're not using good screening processes, and if they didn't do enough value add, what we call value add in the business, to the property, to upgrade the facilities, the amenities, make it look nicer, then they're going to struggle to keep a good tenant. And those are the most dangerous situations. I mean, they just start to become overrun with crime and blight. You start to have more problems with things like bed bugs, realistically, and insects. And then once things like that hit an asset, it spreads like plague through the whole asset, and that becomes a problem. So when you didn't take meaningful consideration of getting the right tenant and doing the right things to the asset to avoid those things, you're going to have a lot of problems on the back end with those things.
Yeah, I got you. And that makes a lot of sense, just kind of properly vetting the tenants, and maybe like the lack of experience is kind of bite you in the butt here, especially, as things get a little bit tighter with inflation, interest rates getting higher, obviously, people might start to lose jobs as unemployment goes up, student loan debt, the list goes on potential issues that can come arise here. But, that also leaves me with the question as, you're sitting in an Airbnb right now, right? So, I'm trying to get an overview of like both long-term and short-term rentals, because it seems like from, I guess just the voice on Twitter, I don't know if you've been around long enough to kind of hear, but they're blaming a lot of these, the inflated housing prices on Airbnbs, because people were coming in and kind of fixing them up or whatever. And, maybe the general consensus around Airbnbs is the quality is kind of going down compared to, maybe just a generic hotel. Maybe some people have had some bad experiences here or there, but, I still think in some strong markets like, Denver or Tampa, or where people are going to be traveled, they're still going to be looking for maybe some of these unique experiences. So, what is your overall outlook kind of on Airbnb now? And are you seeing kind of a dip down opposed to, maybe the boom that we've been seeing because people are going back into the office and maybe having less of those vacation days and traveling around like that?
Yeah. Sorry guys. I am so not used to being on video here, and I don't like it, but I did it for Brandon. I will get this all figured out next time, as far as a better room and a better situation. The the short-term legislation has moved through the country like rapid fire. I said this about 2 years ago in Clubhouse. I told some clients 3 years ago offline. I was like, I'm really worried about how fast. I've never seen real estate legislation move through the country so fast. Why does that matter? Well, people are complaining, and they're when we go back to your statement about, hey, that they're using that as part of the reason for why properties are going up in value. Well, there's a supply demand narrative for rentals, especially in high demand areas. People are going to complain the most about what they want the most. So if you've bought a good Airbnb property in Tampa and you're closer to downtown or closer to the beach, of course people are going to be upset that more and more of that's turning into Airbnb. That is part of the narrative, but not as pronounced as it seems. It's more what gets more attention. The legislation piece, though, is super interesting because if you're buying something, underwriting it for Airbnb math, and then you have no fair market rent consideration on the bottom in case something goes wrong, those properties are either going to get sold at a fire sale, they're going to get lost, and then that's going to take those neighborhoods or those condominium complexes and kind of move them backwards. So one thing I would say to be aware of is midterm rentals. If you can kind of pivot in there just as an investment strategy piece, are going to go well. But let's go back to when we were talking about equity-rich capital. One thing we didn't talk very much about, but we brought this up a lot on our social audio spaces on Dream Team, is institutional acquisition. The strongest neighborhoods, the strongest cities, Wall Street's appetite to have single-family houses has never been this robust. They have a strong appetite for that. We're watching them pause right now, but that's just because I think they're just waiting for things to adjust. Most of those teams that I'm aware of haven't been disassembled. They're just on pause. So they're doing some kind of house cleaning items while they wait for the market to readjust. And they're going to have, they're probably going to go right back into where they were going back into before, and they're going to go on a buying spree. They're not stupid. So their numbers are telling them that a lot of these markets are pausing and that the values are dropping a little bit where they want to be. So they're going to take advantage of that. They also might be trying to figure out how to raise in their capital stack a little bit better rates, or, I don't know. I don't know what they're going to do. I've talked to a lot of them over the last several months, but not over the last several weeks, to see how they're pivoting the strategy, but they're just not buying like they were. So if you look at equity-rich capital coming into popular areas, if you look at just regular people wanting to take advantage of low interest rates in their backyard and buy something, if you look at institutional acquisition, and if you look at investor activity, just on people that are buying 2 to 20 properties has increased dramatically. Those are a lot of things that those people are competing against, which in those particular neighborhoods and areas have pushed prices up. And then you have a lot of people that are buying lifestyle investments, that second home, that third home, whether it's just for personal use or whether there's some sort of social impact that they want to do it with. A lot of people went out and bought properties for their kids that they didn't care as much about that before, but they saw in certain neighborhoods, in certain situations, inventory just disappearing, and they were worried about their kids being able to move back and live close to mom and dad so that grandma and grandpa could have access to their grandkids. So all of those categories saw a dramatic increase, and we've spent many hours and many conversations during Corona, and now more strategically, I'm a master admin in Burr with Joseph Scree, so we talk about this stuff from time to time. Main Street to Wall Street, Dream Team, Twitter Spaces. I usually pretty much just go to Green Candle Investments because I trust Brandon's insight and decorum on how he runs a stage, and I follow Bobby J and Neely over there. So I'm very picky about where I want to keep company, but when I do, I want to make sure that there's collaborative intelligent insight, and we're sharing information so that we're all kind of casting a better what we'll call a less foggy crystal ball, I guess, right? As far as what's going to happen for real estate or stocks or anything out there that impacts us.
Yeah, for sure. And I agree with you 100% there, right? I think the sharing of information from people that have boots on the ground and that are experts in their field really can't be undermined in this scenario, especially when it comes to real estate, because everything is, so regional and can be different from market to market and everything like that. It's really hard to get like a full grasp on things because, like I said, it varies from market to market. But we are kind of having this banking crisis kind of go on right now in a lot of regional banks. So I'm not quite sure. I don't know if I prepped you for this one or anything like that. But do you think that that's going to affect kind of some of the lending practices that we have, for houses, whether it's personal mortgage or something for maybe some rental properties or something along those lines?
What's interesting is I, guys, asked Brandon to pop into a small little stage the other day and put him on replays so that this question that was coming up over and over again in some of our social audio spaces in the clubhouse could be addressed. And I knew that, I saw Neely and actually Shlomo listening on Twitter Spaces to what was going on with Jerome Powell's speech for 3 hours, and I thought I'm going to have Brandon come in here and give us a little recap of what he heard. I hadn't had a chance, except for what I'd seen in highlights and some texts and Twitters back and forth between colleagues. Hadn't really had a chance to go listen and break it all down, and so I was just as curious myself to see what he was going to say, and he did a really good job of that. And then Brandon and I were just talking about this the other day, and then right afterwards, we had the global banking situation just really come into question, right? And the next day, there's a guy, Mr. De Silva, who is very qualified and educated in the London spaces of raising capital and equity. And he came in and kind of explained to a lot of people what was going on, what the danger was. And I thought it was fascinating because he understood the American banking system well, because he's in and out of investments with it and clients that hold funds in their in American banks. To have someone from a London perspective really kind of break down what he was seeing. And one of the things that I took out of that was indifferent from a lot of the other narratives was that even though there's different reasons on how we got here, I just started to hear something that just resembled parts of the global financial crisis. And it wasn't that we haven't learned a lot. It wasn't that we're in the exact same position. We know from a real estate side where I think they're different, but it was the same narrative as far as banks collapsing. I used to do a lot of business with, we used to have plaques on our wall for how much business we did with Aurora Loan Services, who was a division of Lehman Brothers. And when you look back at what happened to, say, Countrywide or WAMU, it's kind of easy to understand why they had problems. But when you look back at Lehman Brothers, I mean, they really should have been able to have been bought for way more than they were bought for. It's not necessarily for what they might have wanted. And this is where I've been teaching a lot of my people and the mastermind people to go back and watch The Big Short, because for as many things that are different about the global financial crisis, it's funny how recently, in the last 2 weeks, we might be going towards the same end. I don't think we'll get there, and I don't think it'll be as chaotic as it was before. But gosh, who thought 3 weeks ago, Brandon, that the 16th largest bank or wherever it placed, along with several others, and now they're talking about all the others that have books that are in this same economic narrative. Who would have thought that they were so close to something that would just create a run on the bank and create all the problems that it's created? It's definitely something that we have to be aware of. I think one of the reasons that the strategy that we've been focusing on for a lot of our investors and for myself and other clients, we're dialing it into it deeper, because I want to go to vendor rents. There's a huge shorting supply. There's a guy, Brian, that I've become good buddies with on Clubhouse last several months, and that's their whole focus, right? They've created a fund and a prop tech to kind of identify these markets, identify these neighborhoods, and he always talks about the 7 million housing deficiency that's out there, plus for affordable housing, and how much of that can be funded by Section 8. Or things like Section 8. So I think those are spaces that won't impact our investors, and we're kind of sticking to this playbook. I think your legacy neighborhoods have a lot of solvency. When you look at a B plus neighborhood, you've got a lot of people in there that have good jobs, or that own their houses, or that have good equity in their houses. And so, I know in Colorado specifically, some of my B plus neighborhoods that I was really a big fan of, they dipped anywhere from 4 or 5, in best case, worst case, 8 to 12% from their market value during the global financial crisis. And some of the C plus neighborhoods took a hit of 60, 70, 80% as far as their value goes. So if those narratives were to come close or to look the same, again, as far as who's in the market on the real estate side, who suffers from that, what cities suffer from that? When we go to this backdrop of, what cities are in, negative growth, no growth, okay, good, strong growth markets, all those things are going to factor in. So you might have hardly any B plus neighborhoods in Denver get hit, you might see some of the C minus, and C plus neighborhoods get hit. But if I were to take that same narrative over to, say, Cincinnati, that would be a rougher narrative. If I were to take it to St. Louis, it'd be even a rougher narrative. You would have actually some B neighborhoods getting impacted because there's a certain domino effect that goes with the neighborhoods next to you. You can have what's called a socioeconomic frontier where, there's dramatic value difference, like one side of the street 50, the other side of the street $150,000. But when they're next to each other, the banks don't always know how to break down those zip codes and exactly where those socioeconomic frontiers are. So more often than not, in a market like this, the neighborhood next to the good neighborhood pulls that neighborhood down. And so that's just something to be aware of, not just for rents, but for appreciation. And for, just if you're trying to calculate your net worth, that's going to take a hit. So all those things kind of matter.
Yeah, for sure. And obviously, like majority of homes homes around the country have some way, shape, or form, some debt to a bank that is, in turn owned by that. And then, all these factors, that kind of factor into housing just kind of all lead back. But it seems like housing is kind of a lagging indicator when it comes to just the overall macro environment. Now, I've kind of discussed with you on other platforms that I thought that the Fed was not going to raise or stop raising interest rates throughout the rest of the year, whether that's, they raise next meeting, they kind of go through a pause, but they kind of continue to raise and they don't really pull back until 2024. Well, at that point, I didn't know that the banking system might be collapsing around us. So I don't really know what to think now. And I'm kind of curious to see how you think that the rest of the housing market is going to play out the rest of the year, kind of based on that. Maybe there's some of that uncertainty. Do you think, more people might kind of flock towards, housing, as it's been rumored, or they've been discussions around potentially injecting $2 trillion back into a back of liquidity to kind of help bail out some of these banks? Do you think that will potentially reinflate some of these housing markets, or do you I guess I'm not really sure if that policy will cause housing to reinflate, but if with that injection, if Jerome Powell and the Fed will kind of continue raising interest rates, how that will all play out. I'm just kind of curious as to what you think, for the overall housing market for the rest of the outlook of 2023. I know it's a tough question to kind of pull out your crystal ball, but and a lot's happened in the past week, to say the very least. So on that note, how are you kind of feeling about the rest of the year, and what are some of the things that you're looking at?
Well, it's funny because for 18 to 24 months, we were watching dramatic appreciation impact most of the markets across the USA that were the strongest growth markets. There's a lot of good comeback markets. I think Cincinnati and Cleveland are good comeback markets. I think Kansas City is a good comeback market. But there's reasons why I'm not mentioning Toledo. I think Nashville is doing really well, but there's reasons why I'm not mentioning Memphis. Because a state alone can't just pull a city out of the disrepair that it's been in for a long time. In Michigan, Detroit is such a mixed bag of tricks, but as you get out to places like Battle Creek, you have a lot more problems in Battle Creek than you do right down the road in Kalamazoo, which both kind of sit over in that southwestern corridor. And I think that, like everything, the biggest problem with real estate and the biggest advantage to these social audio spaces is we record late. And even when we record, we're reacting off of market sentiment that in best case is 30 to 60 days old. So when the market's shifting dramatically and you have a precipitous fall or the potential for a precipitous drop in value, or when the market's going up, you're never really able to measure until after the fact where the height of the value is and where the bottom of the value is. And as a result of that, it becomes, the most difficult 800-pound gorilla in the economic narrative to predict. But I do feel like there's places where you can just protect yourself in the current market. And one of the things that I would just say in general is don't go for the best return in real estate. Go for the best property that has safety net in a worst case scenario and has upside in a best case scenario. So let's just say that you were buying a property, and I'm just going to pick Alabama, okay? And you're buying something in a decent little city in Alabama, and you see that the fair market rent rate will give you a decent return, like nothing spectacular, but maybe 6.5 to 9.5, 10%. But if you do a little midterm rental, you're going to get a great return in the high teens to low 20s. And you have to make sure that that investment and that investment plan line up with your life. That you have a proper management team, or that you're going to have a proper management strategy yourself to do that. You've put yourself where you know what your worst case situation is. Fair market rent, I get 6.5 to 7.5% or more. If I'm able to do a midterm rent, okay. If anything goes wrong, I bought some furniture. I put a couple tenants in there for 60 days to 6 months. I either don't like doing it or I'm not making enough money, so I lower my prices. But then I see if one of my tenants wants to go long term or I go to long term. I'm just protecting myself, because the one thing about real estate is it's a long game. As much people do it for the short game, some people make a lot of money. It's funny how many of the people in the short game are out of the game after 2 to 5 years, because they just can't sustain that momentum that they took advantage of during some sort of magical market moment or market trend that happened, whether it was timing or location that they jumped into. Or they get too greedy, or they don't balance things. But real estate always pans out. You're leveraging the bank's money. It's cheap money. You're creating equity over time. You can work the margin of the cash flow. So if people don't get greedy right now, and they just sit somewhere where they can get a safe, good return, but have upside, I think that's the best way to play the market. You see something that if things go well, you can have upside. And upside can come to you in one of two ways. Now, like creating a midterm situation instead of a short term, which I feel like is way too volatile for most people, and a little bit better return than a long term. So that might be targeting a traveling nurse or an engineer that's come to town. Or you can sit there and say, okay, I know that I'm not getting great margins today, but I know rates are going to go down. Nobody smart thinks they're going to go to where they were before, but they are going to go down. And then when the market turns, if I'm in a really strong neighborhood, I'll probably see some good things go in my favor as far as appreciation and cash flow. If I can leverage those things, those narratives, whether I'm going for kind of more of a blue collar government fixed income rate rent, or whether I'm going for a stronger neighborhood, I'll be good. I really feel like in some parts of the country, the B minus, the C plus, a lot of the things below the C, you have to be aware of. But if you have a strong, sustainable C plus neighborhood and a strong MSA or a good growth MSA, or even a no growth MSA, but it's been C plus for 20 years, it'll probably be C plus for another 10 years. And a lot of times it's a 1-car garage neighborhood where a lot of people own their houses. Those things are going to be fine.
Well, what about when it comes to like multifamily? Because it seems like to me that you kind of described like the neighborhood outlook and how that's going to go. But I guess generally speaking, maybe this is just anecdotal, but I know some of my friends that are, maybe we're thinking about buying, but now that they're seeing the interest rates go up, their narrative is, oh well, we don't want to pay these high interest rates. So instead of going to maybe a single family home, or even renting a home, they're like, well, we can get a nicer apartment anyway because we were looking at potentially making a big down payment. Now we're going to put that off and just have that money kind of sit in the bank. So they're looking at more of, I don't know, maybe B to B plus, or maybe even A, some of these apartment complexes. So, do you think that that's going to be kind of, I guess, more of a common thing, or do you think that's maybe just like an anecdotal situation that we've got here in a bigger city that, has a lot of development going on?
Well, small multifamily really stops at 4. In my book, by management and scale, it kind of stops somewhere in the teens to 20s. And I don't specialize in a lot of stuff over 50, except for to see by evaluating that LP position if a client should be placing a chunk of change into a syndication to see if it's going to go well. Gosh, I don't know how to summarize an answer for your question, but I will say that if I took a certain person in a certain part of the country, I would probably get a very different answer. And that same person in the same financial position might do things differently in different cities, because I don't think it's lost on people how their city is compared to other cities around the country in what we will say the middle class and upper middle class space. Okay. Sometimes in the blue collar space, they've had an anecdotal experience, or maybe they moved around the country if their father was a trucker or in the military. But for a lot of the middle class and upper middle class, so many people are not, we're 40, 50 years removed from the predominant amount of people go to college in state, stay somewhere close to home, and live within hours of their original birthplace. That trend keeps going down more and more. So more and more people have friends from college and life that live in other cities. And it's not lost on you, if you're in Kansas City, why maybe Ann Arbor, Michigan is a better market. It's not lost on you if you're in Florida, that your friend's freezing his butt off in Pittsburgh in the middle of winter. So I think they're able to sit there and say, well, because I'm in this kind of a market in that kind of city, I think I should be doing this. And if there's anything that we could do today and in future conversations, is continue to bring light to people on what's different about your geography and your personal financial situation and the macro place of the economy right now that should be changing how you buy, when you buy, and what you buy. So anyway, I'm still perplexed in a lot of thoughts about that last question. But if you wanted to dial in something more specific, I guess I could try to give you a more specific answer. But I don't know. There's a lot of thoughts are coming to my head as we have this conversation and as you ask that question. Go ahead.
Yeah, no worries. I know that was kind of broad and just like an anecdotal kind of note that I have there. But I guess what is your strategy kind of going into the rest of the year? Are you going to still buy? Are you kind of are you going to allow us to peel back the curtain a little bit? Like, how are you kind of prepping for the potential of this unknown?
I think it's a good year to buy one or two properties, and it's a great year to prepare to buy two or three next year for the average investor out there who's using BRRRR strategy. Limiting beliefs and information and good guidance are what keep most people back from doing any sort of Main Street investing at scale. So, find good information, get into your rooms. You guys are always asking good questions. I love sharing stages with, you and David and Neely and Bobby, because I'm not just usually I'm coming out of there learning something. Now, I don't have time to learn all the stock strategies of the world that you guys could employ, or bond strategies, but I definitely love when there's an intersection and I can learn something from you guys, and there's something I have to share that might be valuable. I guess the secret sauce this year would just be a rewind back to where I was telling you guys earlier. I really feel like the slow growth and the okay growth markets are going to do really well this year. They still give good cash flow yield. They've been able to stabilize better than they were, say, 10 years ago or 5 years ago. They got some of the really fair market appraised value due that they were due. You had a lot of places like where my kids live and where I have properties, and I live about a third of the year in West Michigan, where, you were just buying great houses in great neighborhoods for $100,000, $130,000 3-4 years ago. That just wasn't going to last, because great neighborhoods and great school districts with, decent amenities, not being in the middle of nowhere. You're 45 minutes from Grand Rapids. That MSA there is 100,000. You can still find things like a Texas Roadhouse. The little mall there is kind of sad, but you can find things like they just had a Chipotle come into the backyard. They just had a Chick-fil-A come into the backyard. So I look for some of those national strong corporate trends that are always growing when everybody else isn't. Chick-fil-A is a great example. And I sit there and say, okay, if that market, so over there, for example, in a nice neighborhood, that $120,000 to $180,000 house has moved to like $250,000, $300,000 on the 180 side. And the 120, 130s moved into like the 180, 200,000. I still feel like there's another 10 to 30% that's going to caption over the next 2 to 5 years. So if I wanted that appreciation and being able to have cash flow, there would be things to consider there. I'm not going to tell you it's easy to manage properties in Michigan as it is in Colorado. And personally, for me, there's two things. There's the equity stakes of clients that I'm working with, because that's going to go well. But I've not hidden from any of my community or my social media how rough Corona was. Now, Corona was preceded by divorce, so that never goes well no matter what happens. But in tandem with Corona, it made it difficult. And I'll speak to a lot of landlords out there who, because of things that were put in place to them, back to blue states especially, heavy landlord policies that were either short term or even might even be considered they're going to do a long term, that were put over them to restrict them from being able to do what they needed to do. The tier 2 landlord and some of the tier 1 landlords and a lot of the tier 3 landlords. So that's who's getting started out. That's who's been doing it for several years and has several properties. That's who has a bunch of properties and and they have good income, but they don't have enough to offset all of the woes of they've gotten beaten up. And there's 15, 20, 30% of them. And the government has done little to nothing to help them. But yet their role is so important as far as being steward over people's living, right? So that's a rough situation. There was a lot of stuff that I was supposed to be doing last couple of years that I couldn't, either because the government didn't allow it or because the capital wasn't accessible. And now I have to get all that going now that we're coming out of Corona. So I feel for that person. I am that person, but I have clients in all different places. So
that's awesome stuff. And this has been a great discussion on the overall, just kind of, all different aspects of real estate and kind of how that's affecting the, greater economy and, the consumer and everybody, whether it's the banks raising interest rates, the banks collapsing, Airbnb, long-term renter, all those kind of things, how they're intertwined with the economy. So on that note, Shane, for those who are maybe looking to connect or listen to you in some of these spaces or some of these, audio things on Clubhouse, what is the best way to find you?
That's funny, actually. I'm going to try to hold up. Let me grab something real quick, Brandon, because I don't have it on me when my pen rolled off earlier. But one thing, on Clubhouse, it is Shane LTM. My full name is Shane Lehigh Tulunga Mangale. Polynesians don't have short names. Maybe that's why we have big shoulders, so we can wear them on the back of our football pads. At least that's what the comedian Sinbad told us one time when we were at the Cotton Bowl. So LTM just makes it a lot easier, and you can find a lot of those handles. I'm going to grab. Maybe I should just, if I get this to you offline, you could post it or something afterwards or something, couldn't you?
Yeah, for sure. So I'm all the ways to connect with you in the show notes as well. Shane LTM on Clubhouse, Shane 52801 on Twitter. I see that you have real estate wealth mentoring.com in your Twitter bio as well. But I know you're more active on Instagram. Is that right?
I need to be. I was. I've got a great strategist, Monica Van Lanningham, and I just need to kind of tune in and get her more content. My director of community for virtual stuff is Melissa, and then we have a campaign called Genesis, and I have a director of Genesis named Jill. Lovely realtor you guys want to get to know for all things Missouri. She does a lot of stuff in Joplin and Columbia, and you've gotten to meet her too as well, Brandon. I would say the most 5 common places to find me are Main Street to Wall Street, Dream Team, Burr Stages, and Green Candle Investment. Like, I spend 85 to 90% of my time on Twitter, wherever Brandon's at, or Neely, or Bobby J, or someone like that is at. So if I'm coming over to Twitter, it's somewhere where I recognize or I know the conversation is going to be good, and I'm going to appreciate what's going on. And I do apologize sometimes, guys. I pop in and I only have 20 minutes or an hour, but there's a lot going on. But I also plan on coming back here with Brandon and doing some more of these. I will get a better camera situation figured out. I'll get a better outfit and everything for TV, or maybe I'll just put this hair up in a man bun so it's not bugging me the whole time. There's a lot of cool stuff. Corona with social audio brought an amazing book of people to get to know and to collaborate and have these kinds of conversations with. It also brought some baby fat back. I picked up 3 or 4 sack of potatoes. It was too much of a temptation coming back to my favorite Denver restaurants. They're good food and they're cheap. The best ones are usually cheap. And then, man, Tampa. We were just talking the other day. What was that called over there? It's not the Columbia. It's that huge restaurant.
Yeah, Columbia is the one.
It is, right? Right, over there in
Ybor City.
Ybor City.
Yeah. So if you guys are ever in Tampa, you should check out Columbia. Get the 1905 salad. They come and make it in front of you. And then, you can't go wrong with like any of the dishes there. So
My
I always bring people out of town into that one because it's so historic. I think they even have like a cellar down there from when it was like Prohibition times where they would like kind of
speakeasy. I
yeah.
love that. Yeah. Todd Vila, a good friend of mine, came up from Bonita Springs and took me there. And the other thing, there was a great barbecue place in downtown Tampa. That was kind of over close to isn't one of the stadiums or things that are sponsored by the tropical orange juice or something like that?
Yeah, so that's Tropicana Field in St. Petersburg. So if there's good barbecue in downtown St. Pete, I don't really know about it. So I mean, I grew up in Austin, and I went to school in Memphis, and then now I'm here. So I'm not gonna lie to you, I haven't found the best barbecue here. So I don't want to trash anybody, but I haven't had that one if it's close to Tropicana, because I am in Tampa. So Tropicana is out in St. Petersburg.
Yeah, and we were down in St. Pete. Chris Delaney, a good clubhouse acquaintance of mine that I've gotten to know well, was out of town, but when I came to Tampa, but he was able to give me a list. He's been doing a lot of cool things, a lot of small businesses, and he had a really good list of places. And so, yeah, it hasn't, I can't exactly say, Brandon, that as I've traveled to these 70 different metro cities over the last 2 years, that I have always been picking the salad on the menu, brother. So.
I do recommend the 1905 one just because of the experience they make it in front of you, and honestly, like I think it's delicious. So it's a good starter, but you got to get the starter, then you got to get the hefty meal, whether it's the paella or something like that. There for sure.
Oh well, it was so cool to take up that whole block. But yeah, between bad restaurants and really messing up my knee last year, which is feeling better now. I wasn't walking, and the gyms were closed down. It was like the perfect storm. So to all the single cute ladies, give me another several months, and I'll get back on track. Look better in the video. But no, good stuff, brother. I don't do these very often, but I just, for all of you that are listening that are coming over because of me, if there's a couple dozen of you that do that, this is just a good kid, and he is smart and he's sharp, and he has a strong, intense quest to understand what makes the world tick, and economically how we all benefit or should be aware of what's going on there. So good stuff, brother. I appreciate it.
Thank you so much. I really appreciate the kind words. And yeah, so if you guys want to catch Shane in one of these rooms or something like that, I'll be putting all his links in the show notes and in the comments on YouTube. So be sure to check him out and give him a follow, and bug him and ask some real estate questions, because he's I found one of the most knowledgeable that I've talked to. So Shane, thanks so much, brother.
Hey, if we hold up.
All right, I'll hold up 1 second.
For like 10 seconds, I'll try to show you guys. It's called Wonderlist on Airbnb if you guys want a cool place to come check out. But
yeah. If you're
how do I flip the camera? I don't know. Guys, the one thing Brandon knows, like a lot of people, is I'm not tech savvy on this stuff. So anyway, can you see that in the background?
Oh, yeah, that's beautiful. If you're listening on the audio, you got to go check out the YouTube to see the end where Shane is showing us where he has a full view of downtown Denver.
Well, and not just only come to the end, guys, because there's nothing special about me unless you want to see Mr. Q Brandon. But if you do look at Rhino, guys, look at just this neighborhood. How many cranes? Right now there's 7. Last summer there was 11. There's 2 over there you can't see behind. So can you see that, Brandon?
Yeah, I can see it.
Yeah, and it's just the way this neighborhood has gone from an old industrial warehouse district into just kind of the next coolest thing since sliced bread. Yeah, we got some homeless things, and we got lots of things we got to work through as a community, but there's cool stuff going on in Denver. There's cool stuff going on in Kansas City. Everywhere I go, there's cool stuff going on. But don't let cool sway you from your basic investor math and understanding what you need to do as far as your investment strategy, and pay attention to everything, because the reason I like going there with Brandon is because stocks and all these other factors, they impact what you're doing as far as real estate and everything else. So yeah, I should have been here the whole time, brother. I was worried the other day we came outside, and I was worried there was going to be too much wind in the background, but it actually ended up being great. I should have been up here and just highlighted the city the whole time.
Yeah, it's awesome stuff. So everybody go check out Shane LTM on Clubhouse and Twitter and all that kind of stuff. And I'll be posting all that in the show notes. So Shane, thanks.
Sounds good, brother. We'll catch you later.